My, how time flies. Another year ahead. Thanks for joining us. I'm Mark Horner with Fairhaven Wealth Management, and we're going to talk a little bit about 2024 and what might be on the horizon for 2025 and beyond. So, on the agenda, let's set the stage here. So, we're coming off a very strong year for the S&P 500, and so does that mean the opportunities are gone or we've missed the boat? What does the financial strength of the various market participants look like? How are we doing on that war against inflation? A reminder that the investment road is always rocky. And actually, we're going to look at a chart that I'm on my 25th year in this business, and we're going to look at a chart later on that I still need to do a double take on. It's hard for me to believe that the investment markets function the way that they do, but that this is how they work. And then we successfully last year navigated a political discussion. So we're going to give it a second go and talk about whether we are on the verge of a golden age or it's just doomsday. So when we get to politics, I'm going to remind you of this before we really kick off politics, but we are talking only about the financial markets, nothing else. No policy stuff, foreign policy, domestic policy, just the economy. That's it. So let's just jump into last year. So again, had another great year in the S&P 500. This is this chart's giving it some perspective, both over time and some metrics at various inflection points. And so what I'd like you to look at is that top box and the second row, the PE ratio, and this is the forward PE ratio. And we're looking at various points in history. So in 2000, before the tech wreck, in 2007, before the great financial crisis related primarily to real estate, and then in 2020, right before the pandemic, and comparing that against where we are today. So I think it's hard to make an argument that the market's not a little pricey. It's not as pricey as it's been, but again, hard to argue. I think that the market isn't a little expensive. Now, when I say market, let's just remember that this is the S&P 500. So that's going to be a mostly larger companies, U.S. focused, and the investment markets make up a lot of other types of investments. So we're going to talk about where opportunities might lie outside of the S&P 500. So this chart is a comparison versus value style investments versus growth style investments. And the chart on the left-hand side is trying to demonstrate relative valuation. So when the jagged line is above that green dotted line in the middle, again, when it's above that line, that would suggest that growth type investments are more attractive from a valuation perspective than value style investments. And when the line is below that dotted green line, it's the opposite, that values trading at a more attractive valuation. And you can see that this has been the case. It's been below that line for quite a while. Now, why we think that value might finally be poised to have its moment in the sun is related to the right-hand side of the chart, and that is, again, comparing growth style investments versus value style investments in different interest rate environments. And so part of what the Fed has done over the last handful of years to combat inflation is raise interest rates. And interest rates have been raised to, even though that might not feel like it, to more of a normal range. Zero is not a normal interest rate, and they were zero or very low for quite a while. So the Fed, again, in combating inflation, has raised rates to more of a normal range, and the range right now for the 10-year Treasury bond, a common benchmark, is about 4.5% as we're recording this right now. So that's going to line up again on that chart on the right-hand side with the second columns from the right. And so what you're going to see here, though, as you look at the chart on a more taking a look at the chart from a broader perspective, is that as rates go up, the opportunities for growth tend to come down, and the opportunities from value tend to move up. So both from the fact that growth has outperformed value for a number of years, and we've got a very different interest rate environment than we've had over the last 10 years. Both of those factors, in our mind, argue that again there might be a turn in where we're seeing investment opportunity from growth to value. Another factor that contributes to investment performance is how people are feeling about the markets. And so this chart again looks at consumer confidence over time. The dotted blue line across the middle is the average, and when the jagged line is above that dotted line, that is suggesting that people are feeling very optimistic about the stock market. And when that jagged line is below the dotted blue line, people are less optimistic. And just in general, when people are feeling too positive, that can set the stage for disappointments in the market. Alan Greenspan famously used the phrase irrational exuberance when he called, this is how history remembers it, when he called the turn in the stock market in the late 90s and the 2000s. What people often forget is that comment by Alan Greenspan was made in 1997 or 1998. He was 2 or 3 years early before the market actually turned. And so where you're going to see that in the chart is basically in the middle, basically the tippity top of the jagged line in the late 90s and the early 2000s. So we're at a very different place right now, where half the country is feeling like that maybe we're on the verge of a golden age, and the other half of the economy is feeling like it's doomsday. Or I'm sorry, the other half of the country is feeling like it's doomsday. So again, hard to make an argument that we're in a broad-based spirit of irrational exuberance or unbridled enthusiasm for you Seinfeld fans. So again, that would also argue that we're maybe not near a point of some massive correction. So if we could take a look at how the various market participants are financially doing, this chart, and actually I'm most interested in the upper right-hand corner. So the percent of unprofitable companies across various market capitalizations. So big companies, mid-sized companies, and small companies. So where we are right now is on the right-hand side of that chart, and comparing that with where we have been, again, at big inflection points in the investment markets over the recent history, the tech bubble, the financial crisis, and then the pandemic. Across the board, companies are in better financial shape than they were at any other time. So the percent of unprofitable companies are at lows relative to all of those previous times in history. Another data point that would suggest the strength of companies is not anywhere near, again, inflection points before markets suffered meaningfully. That's also true for individuals. So this is a chart that talks about the state of the consumer, and the chart on the upper right-hand side talks about household debt service ratios. As a former banker, debt service is something that banks look at when they're making loan approvals for car loans, for mortgages, for credit cards. The higher the debt ratio, the more risky, basically, the loan would be considered from a banker's perspective. And so if you look at the debt service ratio across the board, it also has not been at a lower point other than in the height of the pandemic. Also suggesting that households are in generally strong shape. The bottom right-hand chart also talks about loan delinquencies. So that's starting to move up a little. So that's a chart to be keeping our eye on. But again, relative to where loan delinquencies have been in history, it's still not setting off alarm bells from our perspective. So hard to argue that the consumer in general is not in solid financial shape. Then when we look at cities, and not the federal government, we're going to get to that in a second, but when we look at cities, it's the same story. The COVID support money that went out to all those cities in an appropriate response to the pandemic. The cities, by and large, have done a good job of maintaining that rainy day fund, and so they're in a financially strong position. So the feds, that's going to be different. So all the talk about the budget. The budget excess, deficit spending. We've got a legitimate debt problem at the federal level. I have, though, heard for the lifetime of my professional career about the dangers of printing too much money, and the federal government is the only market participant that can actually print its own currency. You and I can't, and cities cannot. But again, I've heard for the life of my professional career about the perils of deficit spending. To be completely candid, I don't really understand when that danger is actually going to kick in. So I think the federal government just operates in a little bit of a different way from a deficit spending perspective with that power to print money. And then who knows if the newly formed Department of Government Efficiency, DOGE, is able to rein in federal spending. That will be a neat trick to watch them try and pull off. But if they're able to do that in any way, that would certainly help the federal government. So, just as a recap, we all know this, what we went through back in 21 and 22 with the Fed fighting inflation. They really have only one tool available to do that in a meaningful way, and that's to deal with interest rates. And so again, I think very much an appropriate response, and back to a longer term more normal interest rate range. This chart doesn't quite do it justice. My normal comment, because it only goes back to the early 90s, but if you extend out this chart to a broader time frame, the range that we're in right now, kind of a 4 to 5% interest rate range for the 10-year bond, that is quite normal. And for those of us that have got fixed income investments or some money in banks, how nice is it that we're actually getting some yield from the fixed income side of the portfolio, or from savings or CDs. That's the way the financial markets should work. There should be something like a 3 to 5% yield from more conservative investments. So that also feeds into earlier comments about the stock market. When interest rates are at zero, investors are left with very few options to go and find return. If your only choice in the fixed income world is to get zero and lose purchasing power to inflation, your only alternative is to go look at the stock market. And so that forces more people maybe into more aggressive investments. When interest rates are at more normal levels, which is again where we are right now, that'll just naturally reduce the demand for more aggressive investments in the stock market, which again dovetails into hard for us to see that the stock market is at some point of euphoria and about to roll over. Another chart just on inflation. So this is an interesting one because this is the same chart that we've used over the last few years. And if you cover up the last couple of years on the right-hand side of this chart, and you just look at the most recent peak, which was back in 21, 22. That's going to be that blue line. 2 years ago, we saw the very beginning of inflation starting to roll over, and I recall quite clearly the comment made at this event a few years ago that we're starting to see inflation roll over. We're starting to see the impact of what the Fed has done in battling inflation, and it'll just remain to be seen whether that's going to work out over time. And now, with the benefit of time, has it absolutely worked. So those lines are starting to level off a little in more recent measurements. So I don't know that the war on inflation can be declared as being won, but certainly what the Fed has been doing is having real impact. And this is just another chart talking about the relation between interest rates and inflation. The fundamental idea is that, again, the war on inflation, raising rates, is actually working. That box actually in the upper part of the graph, it does go a little bit back further than the 90s. I think that says 1958 to the present. And so you see the average yields 5.7% versus where we are right now, 4.5. That's where we're coming to the conclusion that where rates are right now, even though they came from zero, are really back to more normal levels. So talking about unemployment, that big spike you see, that's going to be the pandemic, and the economy has settled back in nicely to more of a normal unemployment rate. I would say, back to my academic studies in economics under Professor Sunholm at North Park University, where I went to college many moons ago. I recall very clearly a 5% unemployment rate was considered full employment, and we're right there. So another economic metric that it seems very hard to try and make the argument that the economy is not on solid footing. So the JOLTS report. Kurt's off camera here. Do you remember what JOLTS stands for, Kurt? Job openings less temporary transfers. I'm not. Something like that. It's something. It's something like that. It's something like that. But the chart on the left-hand side, again, that spike. All sorts of job openings, and if you remember a few years ago, some of the economic challenges people were talking about is I can't pay enough as an employer. I can't pay enough people to come back to work because everybody maybe was getting checks from the government to stay home, and so that was another factor that may have been contributing to the inflation challenge, that you flood the system with more and more money, and that's going to naturally drive up prices. That has come way down. So I'm a broken record on this, but there again, that's hard to argue that we're in an environment that's going to we're going to see a rebound in inflation. It just feels like the economy is finding its equilibrium. So neither too hot nor too cold. This is the chart that I talked about at the very beginning. So again, for me, this is 25 years in this business. I'm stunned at what this chart says. So it's a little busy, but what it looks at is year-to-year performance. So that's going to be the wherever the gray number is, wherever the gray bar is. So for 2024, which has got an arrow on the right-hand side, that's 23%. That's going to be what the return was for a given year. And again, this traces it back year by year by year. What the red number is where the stock market was at its low during that given year. So I think that's a small font for me getting old, but I think that's down 8% for 2024, even though the market finished up for the year, the S&P 500 finished up 23. So as you look at this chart going year by year by year, the takeaway is that at some point during the year, we are going to hate our investments in the S&P 500. It's unavoidable, unescapable that at some point, the stock market is going to be down more than any of us want it to be, and more times than not, because there are more gray bars going up than there are gray bars going down, more times than not, the stock market will finish the year in a positive way. With I'd say maybe one of the most dramatic comebacks. That looks like that was like 86, 87. That's minus 34% over on the left-hand side. So at one point, the stock market was down by a third, and it managed to finish the year positive. So this is just, and again, from somebody that's been doing it, been in this business for as long as I have, this is shocking to me to look at every year. So I would say whenever we go through some market difficulties later in the year, this slide is saying that's basically guaranteed. Just remember this slide, that is just part of the experience, and more times than not, it's paid to stay patient and stick to your guns. And even in more conservative investments like bonds, it's the same story. Actually, it might even be worse in bonds, because when you look at this is laid out exactly the same way. When you look at the the full year performance, it's been almost always positive, in any given year, with almost always. Actually, can I see any instance when there wasn't? I don't know that I can see any instance where there wasn't. So where there was always a point during the year when bonds were negative. So just it's important, I think, to let that sink in, that being frustrated with our investments at some point during the year is basically guaranteed. So another favorite chart of mine, the old quilt chart, and for anybody that this is always part of our discussion. So how you read this is each column is a particular year. So if we look at let's just look at the right hand side. So this is 2024, and then you at stack ranked by performance of various asset classes. So you've got large cap, as I'm still on the right-hand side under 2024, and I'm going down from top to bottom. So you got large cap, small cap, a diversified portfolio, that's that white box with the line going through it. High yield bonds, EM equity, that stands for emerging markets equity, that's international. Commodities, cash, REITs, so that's real estate. DM equity, that's developed market equity, so that's going to be like Europe. And then fixed income. So again, just looking at the chart from a broad perspective, the colors are all over the place. And one of my favorites to pick on is emerging markets equity. So if we go back to that's 2010. So that's the third column from the left. Let's find emerging markets equity. So it's the purple box, and it's the third one down from the bottom. So as an investor, let's pretend that we're just an EM. Let's pretend that we're an EM investor. So in 2010, third place. Yeah, I'm pleased with it. So maybe I'll buy a little bit more because it feels good to buy investments that are doing well. Then 2011, EM drops to the very bottom. Oh, I hate EM. I can't stand it. I don't want to have any investments that aren't performing well. I'm going to sell all my EM and go someplace else. 2012, back up to number 3. Oh, I missed the boat, so I'm going to go back into EM. 2013, second from the bottom, all the way down to the bottom. I knew I can't stand EM, so I gotta, but maybe I'm getting a head fake. No, 2014, it's still the worst. No, 2015, it's still the worst. Okay, I'm selling it all. Then it bounces back up, and you go on this roller coaster ride of trying to chase returns when they bounce all over the place. So clearly, the one box on this entire chart that is neither at the top of the chart nor ever at the bottom of the chart is a diversified portfolio. And so it can be a boring way to invest. I will say that with a big smile on my face, because I think that's how investing is supposed to work. It's supposed to be boring, but it's a much narrower range of outcomes and a much easier portfolio to stick with. And then, I mean, let's feel horrible for the commodity investors out there. They're like perennially at the bottom of the investment mix. They had their day in the sun in 21 and 2022, but then right back down to the bottom. So, a graphical representation of the impossibleness, if that's a word, of chasing returns. Much better to stay diversified and maybe look for opportunity in areas that haven't done so well. And one way to do that is just by rebalancing. So rebalancing in any diversified portfolio is just naturally going to be when some things do well and other things don't do so well. Rebalancing is just going to be sell the good stuff to buy some of the not so good stuff to bring it back into balance. That, to us, makes just a lot of sense to manage the year-to-year volatility in the various investment markets. This has really got nothing to do with I'd say the environment that we're in right now, because this chart is true across any time period. That when you're thinking about your investments, the probability of making money has a lot to do with your time horizon. So on the right-hand side, basically 20-year rolling time periods, and this chart goes back to the 1950s. The stock market has always made money over 20-year periods. Almost always made money as I'm moving from right to left. always made money from over 20-year rolling periods, almost always 10-year, almost always 5-year, and then 1 year, shorter time periods, there's more volatility in returns. I think the primary takeaway from this chart is for any amount of money that you've got in your investment portfolio that you know is earmarked for something, and it's got an earmark that's, say, 3 to 5 years away. So that could be buying a house, that could be getting a vacation home, sending kids to college, buying a car. Whatever it is that money is earmarked for, if you know that you're going to need that money within the next 3 to 5 years, it probably makes sense to be thinking about putting that money in a more conservative investment like a fixed income investment. 5 years and beyond, history is just, it's overwhelming that 5 years and beyond, it makes more sense to be thinking about having money allocated to the stock market. Okay, here we go. Back to politics. So let me reset this table, even though I said it once before. All we're talking about is economics from a political perspective. That is it. Just the investments. No other policies at all. Just the investments. So what this chart says is, which I'd say is not going to be earth-shattering news, is that confidence is heavily correlated with your personal political leanings. So if you generally lean towards the Republican side of the political spectrum, and there is a Republican administration, you are more likely to be more positive about what's going to happen in the economy. And the same Democratic-wise. If you're more of a Democratic person, and there's more Democrats in government, you're naturally going to be more optimistic. And so you're going to see that reflected in the blue lines for Democrats and the red lines for Republicans. So again, not earth-shattering. The numbers that I think are important to focus on here it's the second line from the bottom. Actually, you know what, both lines, the absolute bottom line and the second line from the bottom. But let's go to President Obama. So during President Obama's administration, the S&P 500 return during his administration was 16.3%. The economy, so that's real GDP growth, so gross domestic product is what GDP stands for. The economy grew at 2.2%. Then you go to President Trump during his first term. The S&P 500 return was 16.0%, and the economy grew at 1.8%, which includes a pandemic. Then you go to President Biden. The S&P 500 returned 13%, and the economy grew at around 3%. So I will readily concede that 16 is better than 13. But the point here is, and it's really going to get made in this next slide, but the point here is that the economy and the investment markets have just demonstrated this wonderful ability to look through whatever's going on in government and deliver relatively consistent returns. So this one is from last year. So forgive me for those of you that tuned in last year. This is repetitive. I couldn't find, or we couldn't find an update to this slide to really fill it in, but it says it makes the point. So red are Republican presidents, and blue bars are Democratic presidents. And what you're going to see as you look at this chart is that they are upward sloping lines no matter who's in office. And so last year, what I said was if you were a person that when President Obama took office, you thought we were headed for socialism and the end of America as we knew it, and you acted on those feelings from an investment perspective to step to the side, that was a big mistake. Likewise, if during President Trump's first term, you felt like the orange man's in charge and it's all over, the great American experiment can't survive, and you acted on those feelings from an investment perspective and stepped to the side, an equal mistake. So again, purely from an investment and an economic perspective, we would strongly encourage everyone to try and ignore what's going on in Washington. Build a diversified portfolio that lines up with your particular goals. Rebalance it systematically to look for opportunities, but otherwise leave it alone and let it do its thing. The economy is going to be much stronger than any one person. I hope I did it. I hope I'm 2 for 2 in pulling off a political discussion, which is taboo in all business advice you ever get. Stay away from politics and religion. I think I did it now 2 years in a row. So key takeaways. We're coming off a very strong stock market, S&P 500, which has led for the last 14 or 15 years. Might there be opportunities elsewhere? Small caps, mid caps here in the U.S., international, both from a developed perspective around Europe and also from an emerging markets perspective, which I think actually still includes China. Is that right, Kurt? Emerging markets, is China still considered emerging?
It is, yes.
Which is still shocking to me, but which includes China. So looking for opportunities in areas that maybe haven't done as well as the S&P 500. The financial strength, everybody but the Feds, which can print its own money, consumers, companies, cities, we're all in quite solid financial shape. Fed war on inflation continuing to work. Remains to be seen whether inflation is sticky and there are more rate increases coming. My personal guess would be that the Fed's just going to leave the economy alone, absent some massive event. So that would be my personal guess for the next year. A reminder that it's never a smooth ride in the investment world. As an investment professional, allegedly, you're not supposed to use the word guarantee. I think you could use the word guarantee. That the investments are never guaranteed just to be a straight ride up. And then back to politics. Neither the donkeys, no matter how much they neigh. Is that what donkeys do?
They do.
Yeah, they neigh. Is that what? Yeah. And no matter how much the donkeys neigh, or the elephants trumpets, yes, or the elephant's trumpet about how wonderful their own policies are for the economy, neither of them, I think, can lay legitimate claim to being champions of the economy. I frankly think that the credit for that all lies with us, the individuals that actually make the economy run, not the legislators in Washington. So we got a whole bunch of questions that came in, Kurt. Let's answer. Let's see what's on people's minds.
Yes, Mark, we got a couple of wonderful questions from some clients that they emailed in. So the first question, what role, if any, does cryptocurrency play in any given portfolio?
Oh boy, crypto. Okay, so out of the gate hard. All right, so crypto. In general, in the investment world, investments typically have one of two characteristics. They are either productive investments, and so investments where something's being produced, and so that could be a company making something, generating earnings, a bond, generating a coupon payment or an interest payment, but some kind of an investment that actually produces something. Then there are speculative investments. So speculative investments, basically what you're betting on is that somebody's going to be willing to pay more for an investment than you do. And in the meantime, nothing gets produced. So all you're betting on is that the price is going up. That's it. So crypto is not the only one that's a speculative investment. There's going to be things like art. That's speculative. Gold. Actually, maybe even your house that you live in, not investment real estate, but that could be considered a speculative investment. So we're just not big fans of speculative investments. Not big fans of gold. Not big fans of crypto. We would much rather be invested in productive investments. So I think Charlie Munger, Warren Buffett's deceased, may he rest in peace, partner, he described crypto as rat poison. I think I agree with Charlie.
All right, thanks, Mark.
Yeah.
Another question coming in here: what role does artificial intelligence (AI) play in our portfolio?
Yeah, so that's a very timely question right now. So as we're recording this, it's just developed in the AI world, the whole DeepSeek
DeepSeek out of China.
DeepSeek out of China. So for those that aren't familiar with that, DeepSeek came out and basically said that they've been able to produce AI technology they claim that it's more productive than the conventional AI technology at a tenth of the cost. Right.
Correct.
So there's a whole lot going on in the AI world right now, and various AI-related investments and chip-related investments right now are paying the price in the stock market. We don't have any explicit allocations to AI investments in the portfolio. How we get exposure to AI is two ways. One is for the more large cap investments those investments are going to have exposure to the hyperscalers in the AI world. So that's going to be the Metas, Googles, Amazon, Apple, Oracle. Larry Ellison, Oracle founder, was just at the White House recently talking about or in support of an AI investment by President Trump. So we get indirect exposure to AI by being invested in those companies. And then there's another level, and that is some of our small and mid-cap investments. So back to this idea of diversification. We want some of the large, the mid, and the small. Some of our smaller and mid-cap investments, they're invested in the suppliers to some of those larger AI companies. So we've got indirect exposure across the AI spectrum, both the large companies and the small companies. But we think it makes more sense to delegate the specific AI decisions to those companies, the Metas, the Googles, those companies of the world, rather than having an explicit investment to AI.
Thanks, Mark. Please discuss in general terms how you and your team reach investment decisions, and how do you handle different and opposing opinions of the team when reaching conclusions? We always agree, right?
Well, maybe not always. I would say largely more times than not. So I would love to be able to paint a picture for you where there are coffee cups being thrown across the room and fists being pounded on tables and people storming out of rooms and also all sorts of curse words flying as everybody disagrees around the Fairhaven world. That's politics. That's not us. I'd say the political world could maybe learn a thing or two from how Fairhaven deals with disagreements. So we come together collectively as a group. Kurt, how long? I've been in this business 25 years. How long have you been in this business?
24th year.
24th year. There's a whole bunch of decade-long experienced individuals that sit around the table as we're talking about investment ideas. Everybody's got an equal voice to bubble up ideas for discussion, and I would say that we make decisions hopefully by consensus. We have made decisions over the years where maybe one or two people just didn't agree completely, but they were on board with the decision. Where I would say there's more of a toss-up. How we deal with that is we just table the decision to get more information and circle back when we get back together the next time. So I would say that we do. I'm biased, obviously, but with my own rose-colored glasses about how Fairhaven operates, I think we do a pretty good job of bubbling up ideas, having intelligent discussion, and reaching consensus decisions. Am I painting too nice of a picture, Kurt?
I think that's very accurate.
All right, good. Good. What else is on people's minds?
All right. Well, back to politics,
okay,
and we'll see how you can thread the needle this time.
Right.
A lot of questions around tariffs. Trump has talked quite a bit about tariffs. And what's the impact of tariffs on the portfolio, or potential impact?
Yeah, so tariffs have been a part of the economic landscape forever, and I think, go back in history, the tariffs that are being proposed right now line up with the level of tariffs that were back in the 30s, like almost 100 years ago. I find that impossible to believe that will actually play out in practice. President Trump fancies himself a tough negotiator. You can clearly have your own opinion about whether you think that's nonsense or not. But regardless, he fancies himself a tough negotiator. my read on what he's talking about from a tariff perspective right now is a negotiation tactic, and that where things settle out in actual policy will likely differ greatly from what he's talking about right now. But I would say let's wait to see what happens. Another comment, I think somewhat related to this. I don't know. I can't think of anyway a president that is more sensitive to the stock market than President Trump. So, and I think why that matters from a tariff discussion, and actually any policy discussion. My strong guess is that if he sees unpleasantness in the stock market and in some way feels that it's related to a policy that they're implementing, my strong guess is that will get rectified quite quickly because of how closely he watches the stock market. So stay tuned. I would say don't pay too much attention to bluster around negotiations. What else? We got anything else?
No other questions, but always a reminder that you can email us with any questions that you have after watching this presentation. Call your advisor, email your advisor, or let us know if you have questions. Happy to answer them, and we're always available.
Absolutely, absolutely. Well, thank you for joining us. Please do reach out. Do reach out with questions, and we will look forward to seeing you same bat channel, same bat time next year.